Hello and welcome to a special edition of the Retirement Readiness Webinar Series. I am the host, Mr. David M. Vigil, President of Vigil Wealth Services. And normally I talk about retirement planning, and all things related to it. But tonight, or today, wherever you're at, I want to talk about the bond market, the fixed income market. I want to talk about where it's been, where it's currently at, and where it potentially can go if history serves as a factor of what happens. So let's jump right into the data. I'm going to first talk about where interest rates have been. So let's go back to the 1980s. If you can see here, interest rates were north of 12% in the 80s. And for the last 40 years, interest rates have gone down. And when interest rates go down, price of bonds go up. They have an inverse relationship with one another. So vice versa, when interest rates go up, price of bonds come down, which we'll get to that in a second, because that's what happened in 2022. So let me get a better view of this chart here. Okay, let me scroll out. So here we go. So again, January 1980, interest rates. When I say interest rates, I'm talking about the benchmark 10-year Treasury note. So it's north of 12%, and for the last 40 years, it has trended downward until we got to the pandemic, where interest rates got really low. As you can see here, essentially 50 basis points-ish, and then started to appreciate. So when people say, well, I've never lost money in bonds, the reason being because interest rates were so high at the starting point. They're, again, north of 12% and gone south for the last 40 years. So that's a quick look at where interest rates have come. Now we're going to see where we're at today. So we look at asset class returns, and even going back to 2020, you can see here, these are the different types of fixed income instruments. These are the returns. Very few years you see a lot of negative. Most of the negatives are going to be here at the master limited partnerships, MLPs, because they are highly correlated with the energy sector. So oil prices go down, MLP prices generally go down. So, but if you look at the other investments, intermediate corporates, which again, investment grade bonds, you see very rarely are they negative. So here's the peach here, right? You have 2008, which is a tough year for everybody. Intermediate corporates were up, actually they were down 2.76%. But you look at 2022, across the board, all fixed income asset classes except for MLPs, because energy prices came back from here in 2020, where they basically cratered. They came back in 2021 and 22, and they're doing quite well in 23 as well. So why is this happening? Why are our bond prices going down so much? So this chart will show why. You have the Federal Reserve. They are hiking interest rates to combat inflation. They're doing that to slow down the economy, making it less likely for corporations or individuals to go out and buy that home, buy that new car, hence slowing down the economy and not stimulating it. They essentially raise it from zero to where we're at today, which is 5.33%. And if you look here, interest rates are at or near the peak, and that's very important, which when I get to the next set, the next data points here. So here it says there's a 20% chance that the Fed hikes rates one more time. And that looks like either later this year or beginning of next year, January-ish. Most folks are in the investment world are thinking the Fed is done. They're done hiking rates. They're going to sound hawkish to, again, for their overall goal of getting inflation down to their 2% target. Whether they achieve that or not, we will soon find out. But if you see here in 2024, you see the Fed funds rate going from 5.33 down to 4.5. That's 2 cuts next year. So with interest rates going down, as I mentioned earlier, yields go down, price goes up, right? So that's the prediction from the futures market of what interest rates are going to be. And so let's see what that. Well, this is a good chart here. This shows that this is the volatility of the bond market. And the gray bar, the average here, 93.27, from 2021 until today, we have seen highly elevated volatility inside the bond market. What you see here, you see muted going back to 2010 after the financial crisis. You have very muted volatility, except for the pandemic in 2020, where we didn't even know how to price a bond because companies were closed, et cetera. Now here again, we still have elevated volatility in the bond, so interest rates are bouncing around. Okay, now let's take a look at this is the yield curve. This takes a look at the 2-year yield, compares it to the 10-year Treasury yield, and when you have shorter term rates that are higher than longer term rates, it's what's called an inverted yield curve. And as you can see here, when it inverts the zero line, you see the gray bar that generally leads into a recession. So when the Fed's tightening, it hasn't orchestrated a soft landing yet. There's always been hard landings or recessions. But again, I'm not in the camp this time, maybe different. We're eventually going to find out. But history states or shows that when the 2-year Treasury yield and 3-month yield as well is higher, which those are really controlled by the Fed. The Fed raises their rates, their Fed funds rates, and the Treasury yields generally follow the same rate, the 2-year. So the 2-year Treasury yield is higher than 10-year. It is inverted, as you can see, and it's been inverted. There's a lag in monetary policy getting into the actual system. It doesn't just happen overnight. On average, it takes 12 months for things to really kick in. We are about 18 months into the latest Fed hiking cycle, and we're starting to see the slowdown now. Now, next data point here. Again, this is where we are at. So if we are here in a slowdown, meaning the economy is slowing down, we're not in a recession, we're not contracting, but we're in a slowdown, here are the best performing asset classes: bonds, commodities, cash, and equities, right? So that's why I'm having this webinar. I'm first time in a long time, I'm excited about bonds. And hopefully this webinar will show why. And during the contraction, guess what? Bonds are still the best performing asset class in out of equities, cash, commodities. So this shows the price to par. If you don't know bonds, let me explain what par value means. Bonds come out at a par value, let's call it 1,000. Then they go into the secondary market. They trade based on interest rates, based on the company, et cetera, many different factors. The bond price can go up, the bond price can come down. But if you hold the bond to maturity, you get the par value back, which is 1,000. So if you look across the board, all bond asset classes are below par. So if you buy a bond now, regardless of what interest rates do, if you hold that bond to maturity, you're going to get a capital appreciation plus the yield that you're getting along the way. So could interest rates continue to rise? They could, and the price of the bonds can go down. But again, if you're holding it for until maturity, you'll see the price of the bond go up at par. And again, if this doesn't make sense, please reach out to me. I'll put my contact information at the end for you to call or email, and I can go into greater detail. This is just showing where we're at currently at bonds. It was a rough 22, as I showed you the slides before. You have bonds down double digit, which again, bonds are considered the safe haven, the safe asset class, down 12% in 22. Ugly. As I showed you why, the Federal Reserve has raised interest rates quite rapidly to combat inflation. They went from essentially 0, ratcheted up to 5.25, and They could be pausing and cutting next year, or they can raise one more time and then be cutting later in the year, which doesn't make sense to me. They should just basically pause. So that's where we are currently at. So you have bonds below par. Okay. You have bonds yielding north of 5%, some 6, 7% from investment grade bonds. And you have the Fed at or very near the top of the cycle of interest rates. So what generally happens after the Fed pauses? Well, here's the next set of data points. This is what happens. So the last 7 tightening cycles, you see the lines here. I have to correlate this. They're taking the escalator up. They raised 25 basis points, 50, sometimes 75, like they did during this rate hiking cycle. But they take the elevator down when they cut rates. So if you're not ahead of the curve, you could miss some of that. Meaning that, okay, now we know the Fed's on a pause. Interest rates have already adjusted. They've already come down before the Fed's even cut rates yet, because they know where they're headed. So you want to be looking at purchasing bonds based on your, again, time horizon, risk, et cetera. We can have that conversation if you like, prior or right when the Fed is potentially pausing. And here's why. This is what happened. Well, this shows risk return here when the Fed pauses. Average 5-year standard deviation. That's how we measure risk, how much the returns deviate from one another. You look here at the orange bar. This is the stock market, S&P 500, large 500 plus companies of the U.S. This is the Bloomberg Ag, which is essentially the bond index. Same return, roughly the same return, a lot lower risk. And again, here, this shows the risk-adjusted returns, U.S. mortgage-backed securities, Bloomberg U.S. aggregate, which again is your corporate bonds mixed in with some treasuries, and this the straight U.S. corporate bond index, having a better risk reward return. So again, why does that happen? Well, that's because you have the Fed's cutting rates, you have interest rates coming down, and when interest rates come down, the price of the bond goes up. You look at duration of a bond. Let's say you have a 5-year bond, for example, and interest rates go up by 1%. That's 5% that you lost, because again, inverse relationship. Interest rates go down 1%, you made 5% on price appreciation. Plus, you have 5% yield, we'll say. So if interest rates go down 2%, that's 10% price appreciation, plus you're getting 5% a year of yield. Do that math over 2 years, that's 20% return. That's why I'm excited about bonds. You have good yield to protect you if rates continue to rise, right, in the short term. But over 1, 3, 5, and 7 years, trying to show the data here. Where there is no loss. Let's see. Oh, here we go. This is what I wanted to show. Average returns. So again, this is the last 7 hiking cycles. This doesn't guarantee anything. This just shows what the data shows. On average, bonds, after the Fed pauses, in 6 months, they're up 9%. 1 year, they're up 13%. 3-year up 10, 5-year up 10%. They've been positive 100% of the time the last 7 Fed rate hiking cycles when they pause. So again, that's why I'm having this webinar. Excited about bonds. Yields are very, very advantageous for folks. This correlates with retirement, because folks who are in retirement are looking for income. They're looking to borrow, or they're looking to create some type of income. And yields have been very low for a very long time. This is the first time since 2008-ish that we've had yields north of 5%. You have Amazon bonds that I found 1-year maturity yielding over 5%. So highly rated companies, and again, yields very advantageous. As you can see, the last 7 times we've had this rate hiking cycle, 100% of the time, bonds have been positive after the pause. And again, this is the risk reward. I skipped the page here. Average and median returns from last hike to first cut. So a lot of folks are buying 3-month treasuries because they're yielding 5.25%, one of the safest investments currently on the planet. But what happens when interest rates start to fall? The longer you go out on the bond spectrum, the greater return you're going to get. Because again, as I mentioned earlier, duration. You have a bond that's 3 months, interest rates go down, you're just going to make whatever your yield is. You have a bond that's 5 years, paying you 5%, and interest rates go down 1%. That's a 5% price appreciation. So if you're talking total return, 5% income, 5% price appreciation if you were to sell it, which you probably shouldn't, but if you were, that's a 10% gain. And then you have that going forward as well. So lots to like about bonds in the fixed income market. I wanted to get that out. Have you speak to your advisor, or if you're working with one, or reach out to me and I can discuss in greater detail about what's going on. But hopefully this makes sense. Yields are great. We're getting very close. We went through a lot of pain to get to this part. A lot of folks in safe investments that have lost money for the first time in 40 years. So that's, many folks don't like bonds because, oh my God, I had a bond and my bond fund is down 6-7%, but if you were to sell it now and do something else, you lock in that loss, you rode the wave down, let's ride the wave back up. But definitely take a look at what you own and see what's under the hood. And again, if you have questions, please reach out to me. Here's my contact information. I will share this. This is me. Here's my phone number, email address. Any questions, please reach out. Love to help. But again, bottom line is bonds look attractive, very attractive actually, from a risk reward, from yield, price appreciation, as long as we get the Fed pause. Get the Fed pause, you're going to see rates come down. So if you're looking at bonds, fixed income, it's probably a good idea to start doing it really soon. Because if they do pause, or we're in a pause now, you're going to see rates start to come down a bit, in which they've already actually started. So thank you for watching. Hopefully you made it to the end. Hopefully this made sense. Hopefully this added some value to your investment theme here. So again, my name is David Vigil. I will have a retirement readiness webinar series, probably one more this year and then a few more next year. Appreciate your time. Thank you.